Hey friends, it's Brad Brain. Today's February 16th, 2021, and we are approaching the RRSP deadline. The RRSP deadline is March 1st, and any contributions to your registered retirement savings plan between now and then will entitle you to a tax deduction for the 2020 tax year. Now, historically, this has been a very busy time for financial planners in Canada, and invariably at this time of the year, somebody will say to me, "Wow, you must be super busy." But I'm not. I'm just not. Yeah, back in the day I was. When I first started in 1995, roughly 40% of the work I would do in a year would be in RRSP season, but it's not that much anymore. Nowadays, like, my year is busy, but it's not compressed into the 1 month as it used to be, which I'm totally fine with. I like the work-life balance. But it concerns me too, and I'll tell you why. And why it concerns me is because it makes me worry that not necessarily my clients, but Canadians aren't putting money into registered retirement savings plans. Now, if there's a reason for that, then that can be acceptable. Well, I think in too many cases, there actually is not a good reason for that. And I'll tell you what I mean. What prompted this chat today is something I read from a lady by the name of Evelyn Jacks, very well-regarded commentator for the Canadian financial landscape. And she wrote a little piece that talks about RRSP deadline. Most won't contribute, and that will be costly. And she raised an interesting point. So one of the statistics she mentions, more than 56% of Canadians do not plan to contribute to an RRSP this year, and an additional 12% are unsure. So that's a lot. I mean, what is that? 68%. That's a lot of people not putting money in, right? Now, here's the point that she made, which I think is an interesting one to consider. And that is, in addition to just the tax savings, what she mentions is that when it comes to Canada child benefits, people get $300 a kid this quarter for families with net income under $120,000 and $150 per child for family income above that amount. So here's the thing. If you're right at that threshold, an RRSP contribution will reduce your net income, right? In other words, it's not just the tax savings, it's also your entitlement to government benefits that are affected. She also mentions the Canada Recovery Benefit, people have 50% clawback if your individual net income is above $38,000. And she also talks about EI benefits. So there's this raft of government benefits that are income tested, and an RRSP contribution reduces your income. So you can hang on to more benefits by making a contribution, potentially. It's got to make sense for your situation. But that column reminded me of something that a fellow by the name of Jamie Golombek wrote, who is a very well-regarded tax and commentator, financial planning commentator in Canada. And he talks about a little different angle. He talks about RRSPs and business owners. So here's something that I find is that sometimes people they have a business and they're wondering if RRSPs are still a good planning tool for them. And sometimes they are, I don't know, I guess maybe leaning towards the idea that they're going to forego an RRSP contribution. Because, I mean, there's a lot of things that they come into play when you make an RRSP contribution and you're a business owner. You got to take the money out of the business, which is taxable. Now you're going to invest it, but does it make sense to just leave it in the business to start with? Okay, that's kind of the question in a nutshell. And basically what he says, I mean, you can Google this and you find the article for yourself. It's called RRSPs, A Smart Choice for Business Owners, written by Jamie Golombek, December 2020. Golombek is spelled Golombek, or just email me. I'll get you the article. And anyway, his conclusion, and he does some rigorous testing here. He looks at every single province, and there's a big table it's on my other monitor. You can't see it, but I can, about, real, like, detailed analysis here, right? And the conclusion is that for many business owners, withdrawing excess funds and investing in an RRSP may be the better choice. So here's why I mention all this. Oh, there's another thing too. Here's another myth. Okay, the myth is that one of the things that happens with RRSPs that's not attractive, which I'm not saying that this is attractive. That's not the myth part. But the argument is that when you take money out, you got to pay tax on it, right? And because that most people will convert an RRSP into a registered retirement income fund, or RIF, what it means is they're eventually forced to take money out of the RIF. And what that means is forced to pay tax on it, which sounds terrible, doesn't it? Okay, here's the thing. You can defer paying tax until the end of the year you turn 71. You actually don't even have to take money out the first year, but forget about that for a sec. So you don't have to take money out for a long, long time. When you do take money out, you have to take out at least a minimum percentage, okay? And don't have it up on the screen. Anyway, okay, so it's a formula, and the formula, one of the variables in the formula is your age. Basically, the older you get, the higher the percentage. It starts at about 5%. Let's just use that for now. Now, okay, the formula, the percentage you take goes up, but presumably as you take money out, the principal goes down. So all things being equal, you should have relatively level income that you pay tax on, right? Okay, so let's say you have, I don't know, like $500,000 in your RRSP. You convert it to a RIF. Now you got to pay tax on 5%. Well, that's only $25,000. And here's something I'll tell you. This is one of the insights when this is like from actually working with real people and real financial plans versus writing a newspaper column and you have no skin in the game, right? And what I can tell you with working with hundreds of people that have retired, maybe thousands by this point, I don't even know. Actually, it would be. After 25 years, it would be into the thousands. So if you accumulate a lot of money, it's because you have a lot of money. And if you have a lot of money, you typically spend a lot of money, right? So people think that if they have a lot of wealth, that they're good, they're in good shape. The reality is, if you have wealth, you also find a use for that wealth. There's very few millionaires that live on $10,000 a year. I don't know any, right? In fact, the people that I have that spend the most money are the people that have the most money. So what I mean by all that is, if you are successful and put yourself in a position where you have a large RRSP, that means you've been making good financial decisions pretty much for your lifetime. And you've also been putting yourself in a position to enjoy your smart financial planning decisions. And now that you're retired, you're going to want to do that. You're going to want to have at least 25 grand a year coming to you. That's just the way it is. I don't know. I guess I know arguably one exception to that, but even that's not really an exception. It's just more of a personal circumstance. So the point is that if you are going to be paying tax on 25 grand a year, you're going to be doing that anyway, because you're going to want to be taking $25,000 out of your registered retirement savings plan, or RIF, when you retire. You're going to want to continue your lifestyle into retirement. So that's one of the myths out there, is that forced withdrawals from RIFs are a bad thing. Reality is, you don't really see people that are under the horrible obligation to spend money. They're going to want to do it, right? Anyway, that's one part. Here's the other part, though, that's a myth, and that is the old age security clawbacks. Some people say, I don't want to put money into RRSPs because they're just going to take away my government benefits. Not so fast. So here's the deal with OAS clawbacks is, yes, absolutely they exist, but you do not start to see your old age security clawed back until, for the 2020 tax year, till you make at least $79,054. Okay, so if you're making 79 grand in retirement, you will start to have your OAS clawback happen, which is, I think it's roughly like $580 a month, something like that. It'll be in there somewhere. I could look it up. You could look it up too, right? Whatever the maximum OAS is right now. So basically, if you're making more than 79 grand a year, you will start to have your $580 a month clawback, but you don't lose it completely until you make more than $128,149. Okay, so here's what this means. There's a whole pile of people that are on track to have a lot less than $79,000 a year income in retirement. And those people will naturally be concerned about clawbacks. Who wants to have something taken away from you if you're only on track for perhaps a modest amount of retirement income? Nobody would want that. But those people aren't affected, right? If you are on track for, let's say, $40,000 of retirement income, you're not going to be affected by OAS clawbacks because it doesn't start to $79,000. Now, there's also people that actually will make a lot of money in retirement. There are people that will make more than $128,000 in retirement. Frankly, I don't think those people are too worried about the $580 a month, right? If you're making $128,000 in retirement, the $580 a month isn't going to make or break you. Okay, so long story short, OAS clawbacks are sometimes cited as a reason not to contribute to RRSPs. And this is something that's a tempest in a teacup. A lot of people, in fact, I think almost every person who's really worried about OAS clawbacks isn't affected by them because they're below the minimum income. And the people that are affected, they got lots of income. It's not really intended for them, right? It's intended for the people that need it. All right, so where are we with all this stuff? I'll tell you where we are. We've got a bunch of myths out there, misconceptions, misunderstandings. There's the perception perhaps that business owners shouldn't use RRSPs. There's the perception that even average dudes shouldn't because, I don't know, maybe like the TFSA is preferable, but the TFSA doesn't give you a tax deduction, and tax deductions reduce your net income, and net income can be what entitles you to some of the other benefits that are out there. There's a myth about OAS clawbacks. So here's where the point of all this stuff is: make fact-based decisions. Don't base it on what you saw on Facebook or what your cousin told you. Make fact-based decisions. Make decisions that are consistent with your financial objectives. And chances are professional guidance will be invaluable. So talk to somebody who knows. Talk to a certified financial planner or equivalent and get fact-based information so you can make decisions that help you reach your great goals in life. If there's anything that we can do for you, please let us know. I'm Brad Brain. Stay healthy, be well, take care.